Everyone, please welcome back to the last working paper series and the close of the working paper series. We've had a very interesting weekend. We've had some excellent presentations, and we've also had some excellent sort of audience interaction. And obviously, a lot of you have tuned in live to participate as a part of this particular series. I'm very excited that our closeout is in participation and collaboration with the Insolvency Law Academy and Unidroid. I'm also excited to have Professor Unni as the final panelist to close out the session on a very topical issue of financial institution insolvency. Professor Unni is, of course, a full-time professor at the Indian Institute of Management at Calcutta. Our responders to his paper on financial institution insolvency are Satish Kumar Gupta, who has worked as the resolution professional for SRST and has a plethora of experience on stressed asset resolution. We have Miyate Tejasin, who's right now a legal officer with the Unidroid, working as a lead on the bank insolvency project. We have Sumant Patra, who has been a very sort of significant collaborator as a part of this working paper series, not only as a panelist, but also at an institutional level. Jindal University does have a memorandum of understanding of furthering and strengthening education in insolvency, and a working paper is also a very critical component of that. Without further ado, I want to welcome everybody this afternoon and hand over the floor to Professor Unni to make his presentation on India's tryst with financial institution insolvency. Over to you, sir.
Yeah, thank you so much, Ishana. I think I am audible. I think this is one customary statement which we make after COVID days. I hope I'm not muted. Thank you so much, Jindal Global University and Jindal Global Law School and all the supporting institutions. Paper series. And I'm so fortunate to speak on a very important theme, and that too, where I could also get the expertise from a panel of stalwarts who are actually working in this field. So you can actually imagine the kind of the benefits I'm actually getting from this. And this particular topic is something which is, as the name suggests, it's a working paper. Plus, even this topic also, there is a lot of things to be resolved, because globally also we don't have any standard template which we can use. So I will just start with my presentation, and I look forward to all the panelists here to guide me on this. So let me just try to share the screen. Right. So this is the one. Right. So this is the title says it's India trying to grapple with the issue of financial sector insolvency, and we are trying to see what kind of regulatory pathway which we can adopt. It's again a learning process which we started maybe in the last 10 years or so. Even before that, we had issues with respect to financial sector insolvency or troubles, but earlier days, all of you know, the banking sector was primarily dominated by the government-owned banks, or the public sector banks. So all said and done, the kind of faith which people had in the sovereign's ability to pay back the money was always there. So that was not a major challenge until and unless we have witnessed the new era of private sector banks. I would say the new generation private sector banks, which all came up post liberalization, maybe in the mid-90s. So let me try to set the context here. And one major challenge when it comes to financial sector insolvency is the nature of problems here and the nature of solutions which the regulator or ultimately the sovereign can offer here. So in the case of banks and financial institutions, banks definitely accept deposits. Even many of the non-banking financial companies also accept deposits. For example, the one which had been to a great extent resolved, the DHFL was actually a deposit-taking financial institution. So these are all heavily leveraged institutions. And all of us know there is a asset side to it. There is a liability side to it. The assets of the bank are primarily the loans which it has advanced. The liability side is the deposits. And this particular business model actually makes them, they're extremely leveraged and they are facing a lot of risks because of the aspects or because of they are heavily reliant on liquidity. And you can see the kind of loans or the assets which these banks are involved. While the banks have long-term assets, and most of them, the banks which actually got into trouble post 2010, most of them were actually in the field of infrastructure financing or project financing. Most of them were long-term loans, and there were sector-specific issues. Steel, power, cement, certain sectors ran into problems. And the lenders also got affected. So while banks have long-term assets, their liabilities are extremely short-term. All of you know, the moment anybody hears of any kind of dispute in a bank, immediately you will run to the next ATM to withdraw your money. And I've seen it earlier also in 2002. I won't name the bank. There was some doubts about, there were some rumors at that time. This WhatsApp was not there, but some SMSs were floating around, which had some doubts, which cast some doubts about the liquidity of a particular bank, and a lot of people, including me, running out to withdraw my money. So banks that way are always treated differently here because of the biggest danger which they can all be exposed to, something what is called as asset liability mismatch. So because of all these reasons, insolvencies surrounding banks also should be resolved differently, because banks play a major role with respect to issuance of deposits, extending loans. And it also, these days, banks also do a lot of transactions. There's a big transaction side to it. People who are involved or who are actually using a particular payment processor would have realized the difficulties during March 2020, when one private sector bank was put under moratorium because almost all the payments through that particular processor was routed through a particular bank. I don't want to name any bank, but all of you know that. So it's part of the entire financial ecosystem. And compared to this non-financial sector insolvency, the yardsticks which are being used are completely different. We have Satish Kumar Gupta ji here, who has successfully resolved, which we call as the poster boy of India's IBC case, the SR Steel. So here the challenges are primarily to coordinate the debt collection efforts with respect to multiple creditors so that the recovery value can be maximized, and also making sure that the realized value of the troubled entities assets can be distributed equitably amongst creditors if the entity is to be liquidated, or restoring the entity's financial solvency by renegotiating creditor claims if the entity has a going concern value. And here the major challenge and the major intention is to make sure that the entity remains as a going concern. But here you get some more time. You can actually, even though we have a 330-day kind of extension and all here, but unlike a bank where depositors are running immediately to the nearest available ATM, that challenge is not there here. So let us now try to get into the major how the evolution started. So in contrast, the main objective of any insolvency regime covering financial institutions is to find an urgent solution which involves either selling or, if not possible, shutting down the troubled entity with the least disruption to the system and other stakeholders. That's why many of us would have known or at least if you are tracking these kinds of troubles with banks, most of these times the news comes after market hours. The news comes maybe late in the night. I remember sometime in March 5th or 6th of 2020, the news came out around 9:20 in the night about the troubles of a mid-sized private sector bank, which was actually kept under moratorium. The existing legal framework of insolvency. So what is the law dealing with that? We have certain practices which we have been following, but the existing legal framework with respect to insolvency of financial service providers. So I'm talking about the entire FSB space as a whole, not just banks. So it's patchy to say the least. India actually doesn't have any comprehensive legal framework to deal with such insolvency. And in most cases, it's done by sector-specific regulators. For example, if it's an insurance company under IRDA, the regulator IRDA has the powers. So like that. Since many of the FSBs like banks, NBFCs, insurance companies, pension funds are all governed by sector-specific regulators, these regulators are empowered under the respective laws to deal with their resolution. But most of the cases or most of the instances which we all immediately memorize have come from banking sector, and some of them from the NBFCs also. And all of them pertain to private sector banks. I'm not saying there is no issuance, no issue with respect to public sector bank. I remember in 1989, New Bank of India was merged with Punjab National Bank, 1918 or 1990. But both were owned by the government of India. So there was no major crisis. Only for some of those employees got transferred, all those things. But otherwise, it was not a major issue. So when it comes to insolvency of a commercial bank, the Banking Regulation Act empowers Reserve Bank of India to come with a scheme which can be used to reconstruct the bank, or it even has the powers of going for a merger or amalgamation under certain circumstances. I have mentioned all of them. So during the previous occasions, whenever a bank had issues with insolvency or was staring at insolvency, because unlike other cases where you can allow the insolvency to happen and then step in, here you don't have the choice. Immediately you have to intervene. So RBI had resorted to the option of merger of the troubled bank with a healthy bank. Mostly that healthy bank comes from the public sector. Slowly that's changed. So in 2004, if one were to give an example, RBI opted for the compulsory amalgamation of the private sector bank, Global Trust Bank, with the public sector bank, Oriental Bank of Commerce. So this was a kind of it was a merger involved, because RBI found that the net worth of Global Trust Bank had been substantially eroded. It was having a negative net worth, and it had reached a stage where it had to be compulsorily amalgamated with the Oriental Bank of Commerce. All of us know what's a merger. In a merger, what essentially happens is there is a transfer and vesting of the undertaking. The transferor company, in this case, the Global Trust Bank, the entire assets, the entire liabilities, the entire deposits, the entire employees, the entire undertaking has been transferred and vested in Oriental Bank of Commerce. Normally, in every merger, what happens is the shareholders of the transferor company will get shares in the transferee company, or the transferee company issues shares to the shareholders of the transferor company. In this case, as I told you, it was essentially a bailout merger or a bailout takeover. So that couldn't happen. They were not issued any shares. So there was a condition saying that after 12 years, if things change and all, at that time it would be considered, which means the entire equity was written down to zero, but all the deposit holders, they were all saved. So this happened sometime in 2004. In 2020 also, during the COVID, when COVID was actually on, Lakshmi Vilas Bank, a small private sector bank, was also subjected to a compulsory amalgamation involving another bank, DBS Bank. DBS is a private sector bank. To the best of my knowledge, this is one of the 2 foreign banks which have set up their fully owned subsidiaries in India, DBS Bank India Limited. So it was again subjected to a compulsory amalgamation. But the major difference compared to the first one is the transferee company or the surviving entity here is a private sector bank, a foreign private sector bank. During the same year in 2020, in the case of Yes Bank, RBI adopted a different mechanism wherein Yes Bank was subjected to a scheme of reconstruction, which did not involve any compulsory amalgamation. So this is a slightly different template which RBI took sometime in 2020 March. They deviated from their regular template of going for a compulsory merger. So what happened was Yes Bank remained as a going concern, and various other banks, including SBI, if I were to use this name, SBI was the anchor investor here, and following SBI, many other banks also invested in this, including HDFC, now HDFC Bank, ICICI Bank and all, contributed capital. And I think now it's 3 years down the line, so it has been to a great extent revived here. And when it comes to non-banking finance institutions taking deposits, RBI has that power. So this is the sector with respect to, or the story with respect to financial sector. I am talking about the banking and non-banking financial institutions. And what is the regulatory approach, or what is the kind of thought process which we are having to devise a comprehensive mechanism to deal with financial sector insolvency? So since all of us know this is a different kind of entity which we are talking about, it was also, I think it was in 2013 that the Financial Sector Legislative Reforms Commission that proposed for the first time a comprehensive kind of legislation to deal with financial sector entities. And this FSLRC report recommended the establishment of a resolution corporation. And this report was subjected to some major changes based upon public insights. And a second version was published in the year 2014. Almost at the same time, a working group of Reserve Bank of India recommended the constitution of a single window mechanism titled Financial Resolution Authority for resolving all financial sector institutions and also financial market infrastructure entities like payment systems, depositories and all, in consultation with the concerned regulators. And in 2016, so these are all recent developments. Recent means not something which is very old. This all happened in the last decade or so. Till that time, we used to have the same template of a compulsory merger. That was the common kind of pattern which was happening. So in the year 2016, a report released by Finance Ministry proposed establishment of a Financial Resolution and Deposit Insurance Corporation, or FRDIC. And this FRDIC was supposed to deal with the resolution of various categories of financial entities and also provide deposit insurance to banks. So subsequently, the Indian Parliament saw the introduction of a Financial Resolution and Deposit Insurance Bill in 2017, which was referred to a joint parliamentary committee. But it had certain controversial clauses, including a Bailin Clause. There were other positive things also. The FRDI bill provided for a variety of resolution tools, which included transfer of full or portion of the assets and liabilities of the troubled financial entity to another entity, which is anyway happening in most of the templates which we have already seen. The acquisition, mergers, creation of a bridge service provider, which would act as an interim kind of mechanism, which will hold on the assets and later on transfer. And also a bail-in clause. So the bail-in clause was subjected to a lot of criticism because I don't think it has really worked anywhere outside, especially in any developing country. I don't know whether it has been successfully done. Cyprus, we had a kind of it was implemented there, but it was a failure. Denmark had some kind of bail-in clauses, but it involved a very small bank, which they actually, all the smaller depositors were saved, while the senior bondholders were subjected to some losses. But these are all developed rich countries. Denmark and Cyprus can't be compared to a country like India. So bail-in clause referred to, which had a lot of issues and all. Finally, the government had to withdraw that bill. So this is what's happening. And there are again talks of introducing this with a kind of a very limited bail-in clause. So as of now, I'm not aware of any further developments, though I see a lot of reports saying that it might again be introduced or not. So let us see what's happening with respect to the IBC. IBC initially, even though provisions were there, it was not notified. So only in 2019, after the insolvency of, after the major crisis at IL&FS, Government of India notified this provision of IBC, which dealt with financial service providers. So, and there is also a rule, government issued the insolvency and bankruptcy, this 2019 rules, under which RBI has to take action. So it's unlike the other cases where creditors and all go and file. So FSB rules are presently applicable only to NBFCs, which are having an asset size of more than 500 crores as per the latest balance sheet. And they're not applicable to banks. So it is expected that if our FSB rules would serve as an interim mechanism to deal with any exigencies, and rules would be followed by a full-fledged legislation to cover financial resolution of banks and other systemically important FSPs. As of now, we have systemically important banks. We have 3 are there: SBI, ICICI Bank, and HDFC Bank. They are supposed to have higher levels of capital than what we are having. The IBC provisions pertaining to insolvency resolution applies mutatis mutandis. I am not getting into that. So what are the concluding thoughts here? So it's high time that India moves towards a comprehensive resolution framework. We can't have a patchy one where in certain cases we go for a bailout merger. In certain cases, we go for certain RBI pleading with certain banks to put in capital, like the resolution of a bank which happened in March 2020. So what was the major problems plaguing the 2017 FRDA bill? It was primarily revolving around bail-in clause. So we have to see, can we have the law minus the bail-in clause? I don't think then that would be really possible, because bail-in clause is something which acts as a differentiating factor. Why should the government all the time come and bail out an institution which is actually not doing its business properly? So that also is another important thought process here. So can we have something initially without a bail-in clause by the time people are accustomed to this, and then have a bail-in clause where at the last resort some kind of contribution can be made? I think there are certain positive developments which are already happening. The insurance amount has been raised from 1 lakh to 5 lakhs, so that if it's made some 15 or 20 lakhs, to a great extent it will cover large number of almost 99% of the small deposit holders. So like what Denmark has done, we can explore these possibilities. And I would say that to some level of, I would say, an ostensible bail-in already happened in a private bank resolution, which happened in March 2020, where ATR1 bondholders of a particular tranche, the entire money was written down to 0. So the litigation is going on. We have to wait and watch how it will pan out. But to a great extent, they were also, there was some kind of bail-in which happened there, because those were people who, these are again rumors which are unsubstantiated. People were told that these are super FD, so they thought, and many of them may not be even aware of it. So they thought they're getting higher interest rates, so they invested in that. And that particular tranche has been written down. So some kind of ostensible bail-in has already happened. But only thing is, they are for people with higher deposits and all. So something similar to what happened in the case of the Danish bank, where senior bondholders had to suffer. So thereafter, so this can be done. And with this, I think I'm running out of time. So I will stop here. And more than that, I'll be very keen to listen to my other panel of experts who have really guided me on this. Thank you so much.
Thanks so much, Professor Uni. And now I would like to invite the person who smiled when you said bail-in should be provided, Mr. Satish Kumar Gupta, for your comments on Professor Uni's thoughts and his paper on financial institution insolvency.
Thanks, Ishana. And first of all, congratulations to Mr. Uni for presenting such an amazing paper, which captures how financial sector insolvency has evolved over a period of time, and how various government institutions, how the government has really looked at it. Even though various reports or various measures have been taken over a period of time, however, we are really yet to see a comprehensive framework. And there is a need for a comprehensive framework. Before I come to the certain points and which had been raised, I myself being a banker and looking at the financial sector closely, I will take a few minutes just to bring out how structurally the financial ecosystem is different from other jurisdiction, and how the government and regulator, particularly Reserve Bank of India, that is our central bank, has been taken measures and which has helped us to really talk about it, to have a comprehensive framework. So Professor Uni has talked about our various banks or institutions or NBFCs, where resolutions have taken place. So if we look at last 10 years or so, public sector banks, which had a majority share of the credit, that is around 80-85%. So asset quality review was started, and that was the time when CRILIC, when a sort of credit bureau was initiated by Reserve Bank of India, where one particular account or company was NPA in one books of account of the bank, and it was reflected as a performing asset in other books of account of another bank. So where they tried to harmonize the conduct of that particular account across bank, and that is wherein I think we can say the curious case of Yes Bank came into the picture, and how RBI identified that it's most of the books were toxic and that they had to take action. So that was one aspect. How the banks were books were harmonized in having the the same standard of the non-performing assets. Next, post ILFS crisis, that is in 2019, RBI had again taken a systemic overall review of top 50 NBFCs. And please note that NBFC at that point of time had a total exposure which was around 25% of the total banking system. So it had become huge exposure, and RBI again took a review of top 50 NBFCs, and saw to it that these NBFCs had a risk management chief risk management officer appointed, and also reviewed the counterparty exposures. And they had at that point of time looked into counterparty exposures specifically, because it becomes very, very difficult to particularly in the financial sector entities to identify the counterparties. So look through or look in kind of clause which was and that kind of analysis was done, and that is how the RBI had come to the focus on 3 or 4 main NBFCs. So I will say that our financial sector has not, in spite of the international turmoil or internal, so we have not seen that kind of the crisis happening or it getting spread out, contagion, due to the interconnectedness of these entities. So coming to that is how it is different, and RBI has been taking case specific approach, or whether it is ILFS then NBFCs, financial sector providers insolvency under IBC, or whether it is a recent case on 2022, that is Punjab and Maharashtra Cooperative Bank, which was amalgamated into small finance bank, Unity Bank. So RBI has been taking an approach which can be specific to that particular entity, and depending on the features of that particular maybe the exposures, maybe the kind of the credit portfolio, ownership of that particular entity. And what is important is that as Professor Uni has pointed out, that the deposit insurance credit amount as well as the institution plays a very important role. The waterfall mechanism, he mentioned about 81 bonds. Now, in case of PMC Bank, it was made, we saw that the insurance amount was first paid to the deposit holders, and the balance amount was paid to the bank who acquired over a period of time. So this is how we saw that deposit holders were also paid, but then they were paid over a period of time. Now we saw in that particular amalgamation how the waterfall is being treated. Now in ILFS, which was little non-transparent, and that is the first time when RBI was faced with a non-banking institution sort of insolvency, and which really had a big impact. There also, it through an administrator, it was dealt, even though it was not so transparent, but after all, it helped in bringing all the creditors on one platform, and so that decision making was easy. So these were my comments, I think, which are specific to the Indian financial ecosystem, and how, and additional to what Professor Uni has pointed out. But yes, whatever all these measures or the frameworks or which we have seen have been specifically designed for that particular entity by RBI, and RBI has done a lot of hand holding in taking the resolution forward. And obviously, in these the frameworks, various features have been well established. I think that is of waterfall. I think it is very well accepted over a period of time now, whether it is a secured creditor or depositors or or 81 holder or equity holders. So I think a certain aspects have clearly been asked. Now, Professor Uni, I would like to ask you a question that, how does the concept of public nationalized banking impact the manner in which the resolution method should be proposed for commercial banks in India? See, commercial banks, these commercial banks can be public sector or in private sector, or there should be a separate, completely separate framework, which should be designed, or
yeah, I think I'm audible. So I would say that as there is a clear distinction between public sector and private sector banks, even right now also, for example, any kind of mergers or anything, the procedures which are applicable, even the appointments to the board and all, RBI treats private sector banks differently. So for private sector banks, it should be different. So that's my take, because all said and done, in the case of a public sector bank, that concept of sovereign guarantee is very much there. So it's not that people are just immediately running even after hearing some rumors. But a private sector bank, I can tell you that incident of March 2020, the news came at 9 o'clock in the night, 9:15 in the night. Next day, early morning, I was going to the airport. I saw queues before ATMs at 4 o'clock, 4 a.m. So this is the trust factor, which a public sector or a government entity brings in. So I think it should be separate.
Right. So you again one more. So as I brought out how the Indian financial ecosystem is different, and largely the banks are set up under a license from the Reserve Bank of India. And Reserve Bank of India, as we know, have not given out many licenses now, and many many industrial houses or or the investors want to set up the banks, okay, or meanwhile the RBI had come up, Nachiket More committee had come out with a report on setting up of payment banks or small finance banks. So those banks have been allowed, and I feel so you feel there is a if there is any failure on the particular demand, so there is an unmet demand also for taking over those banks to get hold of the bank license.
It's a question to me.
Yeah, it's for a discussion essentially.
Yeah, maybe then we can
to
take
that
it.
extent.
Yeah,
RBI may also, or the government may also feel then since there is a unmet demand or any failing bank, there would be a suitor available in time to come.
Yeah. So can we take it in the end? This specific
okay. Yeah.
question? Yeah.
Thanks so much for those thoughts, Satish. So we'll just, Professor Uni, bombard you with questions and ask for your responses at the end. With that, I'm just going to invite Mehta to give a bit of an international perspective on financial institutions and the separation from bank and financial institution in the context of insolvency. Go ahead, Mehta.
Yes, thank you very much, Ishana. I would like to take this opportunity to first thank Jindal Global Law School for giving me this opportunity to speak here today. It's really a pleasure, and thank you also in particular to Ishana for the excellent organization of the entire event. And of course, many thanks to Professor Uni for the paper, for sharing the paper with us in advance, for now making an excellent presentation on the paper. For me, the paper, I read it with great interest because it relates directly to the project on bank insolvency that I'm coordinating at UNIDROIT. UNIDROIT is an international organization based in Rome, Italy, that deals with harmonization of private law. And among our projects is a project on bank insolvency. I will share my screen because I have a couple of slides that I would like to present to you. Yes, there we go. I hope you can all see this clearly. So before I start focusing on the slides, just very briefly, this bank insolvency project that we're dealing with at UNIDROIT, the aim of this is to develop guidance, legislative guidance for policymakers and legislators all across the world that are seeking to refine or update their bank liquidation frameworks. It is an ongoing project. So we established a working group composed of international experts, 10 academics, and a lot of observers, so institutions and organizations, which also includes the Reserve Bank of India. And this working group is currently developing the guides, to which I will refer also in the remainder of my presentation. So Professor Uni's paper gave me very useful insights in the Indian insolvency framework for financial institutions, which of course for me is very useful because we're taking a comparative perspective in the project. So like he mentioned in his presentation as well, the paper, well, first it looks into the US and UK regime, and then it provides actually an analysis of the current existing Indian insolvency framework for financial service providers, which is, as Professor Uni puts it, patchy, since financial sector regulators are able to deal with financial service providers under sectoral legislation. And then what I understand is that to some non-bank financial companies, also provisions of the Insolvency and Bankruptcy Code may be applicable. But like he says, there's not a comprehensive framework to deal with the failure of these types of institutions. So I'm not an Indian lawyer, and I'm obviously not in a position to assess the analysis made by Professor Uni, or to assess the Indian system as such, but I would like to give my contributions from an international perspective. There are 4 observations that I would like to make, but before I do that, I thought to briefly recap what we have in terms of international guidance at the moment. So this is what you see on the slide. First, there are the key attributes of effective resolution regimes for financial institutions of the Financial Stability Boards. Those were adopted in 2011 and then revised in 2014. These advocate the introduction of resolution regimes for financial institutions that are systemic in failure. So those are normally the largest, most complex and most interconnected financial institutions. And then the key attributes are complemented by additional guidance, like the principles for cross-border effectiveness of resolution actions and the key attributes assessment methodologies. Then I mentioned as a second bullet point, the IARI core principles. So those of the International Association for Deposit Insurance, since the paper also refers to the Indian deposit insurance framework. And third, there are a number of instruments on actually business insolvency law, so from UNCITRAL and from the World Bank, but these normally do not specifically focus on financial institutions, and this is what we are talking about here. So this is also why we started the project on bank insolvency at UNITWA, to provide guidance on bank liquidation proceedings, and actually to fill the gap that is currently there at the international level, because on the one hand, we have the FSB Key Attributes, but it focuses only on those systemic institutions, but there is no guidance for legislators that want to introduce a regime for smaller non-systemic financial institutions. So that is what we are trying to do. We're focusing on banks that would not be wound up following with a resolution process, or that will be wound up after a resolution process. So it's filling the gap at the international level. So the next slide here provides just a brief overview of what the future guide will cover, but I will not go into these details because I would like to focus on Professor Uni's paper today. And there are 4 observations that I would like to make. The first one is on scope, the second one on the institutional setup, the third one on tools, and the last one on funding. So you see them here on the slides as well. So on scope, well, the FSB Key Attributes apply to financial institutions, as I was mentioning. They cover all types of financial institutions. So all those that could be systemically significant or critical if they fail, but in theory, all the types of financial institutions are covered there. Although the attributes are not as relevant, not all key attributes are as relevant for each of those different types of financial institutions. And this is why also, for example, the key attributes assessment methodology distinguishes or has a separate methodology for banks on the one hand and for insurance companies on the other, because there are some adaptations to be made. For state-owned banks, there is not such a specific assessment methodology specifically, but the World Bank did issue a paper on how the key attributes could be applied also to state-owned banks, because they fall in principle within the scope of the key attributes. Now then, in our bank insolvency project, it was decided from the outset to focus only on banks. So for example, not on insurance companies. It was acknowledged that those have a public interest dimension as well, which is why they're often also excluded from general insolvency law, and also the type of financial products of insurance company might be similar to a bank. But at the same time, they're also different animals, like Professor Uni was mentioning. banks have this very typical maturity mismatch between assets and liabilities. And there are a couple of other factors that made us decide that we need to focus on banks specifically. And then the question is actually, what is a bank? Because there can be commercial banks, there's cooperative banks, there's an entire range of possible banks. So what are we actually talking about? Well, we discussed within the working group that you could follow either a functional approach, so looking at the activities, whether these are bank-like activities of an entity, or an institutional approach, a regulatory approach. And this is what we decided to do. So in the guide, we will actually focus on those with a banking license or another license that allows an entity to take deposits. So we focus actually on what we call traditional banks, what you think about of a bank. Well, because and other deposit taking into a specific prudential, and then it allows super management. Banks are normally by a deposit insurance. That might be useful from a talk about later. But having said this, banks and deposit taking in for jurisdictions will give also to companies like money institutions, even fintech. And I think financial sector is quite big, so that might be a relevant consideration for Indian policymakers. So then the second observation is on the institutional setup. So the paper refers to the involvement of financial sector regulators in dealing with failure of financial companies. So the RBI, for example, but I understand that also the courts may be involved in some cases. So these kind of institutional arrangements are very important for the overall design of a framework to deal with failing banks. And at the international level, the key attributes advocates the establishment of resolution authorities, so a specific administrative authority to deal with the failure of systemic financial institutions. Within the working group on our project, we had quite some discussions on institutional arrangements because jurisdictions have a wide variety of models. So in some jurisdictions, there's a court involved, in others it's administrative. But we discussed and we concluded within the working group that actually an administrative model is preferable, because if you involve an administrative authority with the relevant knowledge, such as a banking supervisor or resolution authority or deposit insurer, then these are usually able to already prepare for the intervention, which a court normally is unable to do. They also have access to the relevant information. They have knowledge about the bank, about the banking sector, and they're usually able to take decisions swiftly. So this is what we recommend in the guide, an administrative model, but some jurisdictions may not be able to introduce such model. And for those jurisdictions, we also provide guidance on how a court-based model could actually work as effectively by still involving banking authorities in the process. So this is something I think to reflect on in any bank liquidation framework, also for India, where I understand that the RBI is already heavily involved in any case. Then the third point is on tools. So the paper and also the presentation now provides very insightful examples of how actual failures were dealt with in India. And I understand that this is also by means of a scheme of amalgamation. At the international level, as Professor Uni mentioned, of course, there are the FSB Key Attributes that include the Bailin tool. It's the most known resolution tool, but the FSB Key Attributes also provide transfer-based options. So to transfer assets and liabilities to a bridge bank or another bank. In our projects, we very much focus on the transfer. So transfer of assets and liabilities to another bank, in addition to the option of a piecemeal liquidation. So kind of the general insolvency way of dealing with a failing entity. So why do we focus on transfer options? Well, because you want to protect depositors and financial stability if a bank fails. And the working group believes that this is best done by transferring such deposits to another bank so that depositors continue to have access to their deposits and are not impacted by the failure of the bank. So this is what in the US is called purchase and assumption. It's we call it transfer-based options, but it's essentially a deposit book transfer. So it's not a merger because you would normally transfer only a part of the assets and liabilities. It can be some deposits or all of them, but you would normally also leave some behind in a residual entity, which would then be liquidated in a piecemeal way. Then my last point on funding, the working group agrees that deposit insurance schemes could play a useful role in funding interventions to deal with failing banks, both for paying out depositors. So normally if you have a piecemeal liquidation, depositors that are insured by a deposit insurance scheme, they get their money back through a payout up to a certain level. But what a working group has been discussing is that actually the deposit insurance scheme could also play a very helpful role in transferring assets and liabilities to another bank, because it will often be the case that assets and liabilities, they don't match if you transfer only part of them. And then it might be difficult or even impossible to find a willing buyer, a bank that would take up that amount of assets and liabilities. And in such cases, it could be very useful for the deposit insurance scheme to contribute to funding that it would otherwise have paid out to depositors, to contribute it to facilitate a transfer of assets and liabilities to another bank. So I understand that in India, there is a deposit insurance scheme, and the Indian Deposit Insurance and Credit Guarantee Corporation will reimburse depositors in a classic liquidation. But I think this other option of facilitating funding for a transfer could also be a helpful consideration. So these were my 4 points on the paper. And of course, I'm very happy to answer any questions or provide additional information on our project. Thank you very much.
Thanks so much, Merte, for those insights. I would, for the final word now, like to invite Mr. Sumant Batra.
Well, thank you so much, Professor Shah, to give ILA and me the opportunity. I congratulate Professor Oni for his paper, and we look forward to this developing as we discuss this today, and more observations coming. And also, my dear, it was very, very enlightening to know about the work that you're doing. And I'm glad that you were able to share, because there isn't really much visibility at the moment in terms of the work that Unicorp is doing, and essentially because we all understand that it's still a work in progress, and you are not able to share most of it in the public domain. But to the extent that you were able to share, I think that was very helpful, and I'm sure that will also be incredibly useful to Professor Oni in shaping his paper going forward. I just want to make 4 or 5 very quick points. First of all, I think from our perspective in India, we just need to appreciate the greater urgency that exists in formulating a policy around this. We don't have the luxury of the taking as long as the time that we did for our corporate insolvency law, which took almost 2 decades for us to be able to come out with the legislation. We today live in a very different world, a very fragile world, and especially after COVID, as well as the other geopolitical developments that have taken place in the last 7 to 8 years in particular. We all can see a new global order emerging. And in this new global order, I don't really see how we can actually afford to have any policy or any law which we might believe would be sustainable for decades. anything that we formulate as a policy, as a legislation, as a regulation, or even as practices, have to be prepared to evolve very rapidly with the changing times. And it's a reality that the times are going to change very, very rapidly around us. We can clearly see that what we are at the moment living in is a process of a new world order emerging, and how and where it will end up in 4 to 5, 7 years is anybody else's guess. The other point that I want to make was that besides the urgency, that I don't think we can live with this comfort or belief that any institution is too big to or too large to fail. I think Lehman Brothers proved us wrong there. Although, of course, that was again a conscious policy choice that was made by the US Treasury not to support Lehman Brothers. We all know that. But at the same point of time, I think there are similar choices that could be made in many jurisdictions because of the policy compulsions, political compulsions, or reasons that policymakers at that point of time have to grapple with and struggle with when they decide which institution to support or which not to support. And therefore, we have to be prepared as far as a policy or legislative framework, institutional framework, regulatory framework is concerned, to be able to deal with the worst, to be able to deal with failure of any kind of institution of whatever size it might be of. And why they make these 2 points as starting observations for some of the very limited points that I want to make is that when it comes back to India, we need to keep this in mind. And I do believe that, of course, we are getting into an election year. We would see a new parliament in place sometime towards the middle of the next year, probably a bit earlier than that. And while, of course, a lot of groundwork is being done, as I think you also mentioned that Reserve Bank of India is part of the group. But I also know that there are some discussions that have been happening in the back channels to sort of stay warmed up on this particular subject. And clearly, we see this as something which would probably occupy the mind space of the tables of the policymakers in the next year. And when we do that, quite clearly the unit work, the legislative guide, will come in very, very useful. And therefore, we are really very keenly looking forward to the product so that we can benefit from it in terms of India shaping its policy on the bank and financial institution insolvency. Now, to the more specifics, I just think there are 3-4 areas on which we need to make a call or take a call. While, of course, the nuances, the fine print of that is something I think we'll have the benefit of the Unit document. And of course, there are IMF, World Bank, and other institutional guidelines that are available. As a combination, they will be available for us to be able to sort of create what we might just consider in India to be a most suitable legislative policy, which draws from the international best practices, but also keeps in mind the local dynamics, including the points that have been made both by Professor Oni and Satish, that we are largely a public sector dominated, banking sector. And therefore, to some extent, that is a consideration that will always weigh in the minds of the policymakers when they formulate their policy. But to my mind, there are 4 areas in which I think one will have to make some very critical, difficult policy choices. The first is whether we should really have a separate legislation for bank and financial institution insolvency, or should it be really made part of the Insolvency and Bankruptcy Code itself? Because the policy choice that India made in 2016 was to have a comprehensive code of insolvency and bankruptcy. So this is not just a statute which deals with one particular component of the economy or the industry in terms of providing a solution for resolution. So the whole objective of Insolvency and Bankruptcy Code was to provide a comprehensive single code that will deal with the insolvency resolution of all those enterprises or individuals that may be amenable to, or that may need access to, or that that may need to be provided a solution through an insolvency framework. And at the moment, what we is corporate entities, like those which are corporatized or enrolled or incorporated as a company, and the companies like, then we have limited liability partnerships. And going forward, of course, although the law provides already there, it sits on the statute book, haven't been implemented as the partnerships, the proprietorships, and of course, individuals other than those. The law has been implemented in respect to those individuals who have given guarantees for corporate loans, but it hasn't really been implemented in respect to the other individuals. So why would you want to really exclude the banks and financial institutions, having included the financial service providers also in the code and not bringing out a special legislation? Now, of course, I have to qualify by saying that, whatever all I'm going to be expressing as my suggestions are purely in my individual capacity. These are not something that would necessarily represent the views of the Insolvency Law Academy or any other institution that I sit on or work with in any of the capacity, because we still have to examine all these aspects very keenly, very deeply at ILA. We have taken a number of initiatives in order to sort of discuss and deliberate this, but at this point in time, we don't really have anything inclusive on the basis of which one could say that my views are institutional representations. So I would just at the moment qualify that these are my individual views. And my personal view is that it would make an absolute sense to have it as a part of the Insolvency and Bankruptcy Code as a separate component. The challenge in that, of course, one would have to sort of deal with is the Insolvency and Bankruptcy Code as it sits today, as is under the administrative control of the Ministry of Corporate Affairs, which deals with the corporate entities. While, of course, if you're going to be dealing with the financial institutions and bank insolvency, that would be under the Finance Ministry. And therefore, then how do you have two separate ministries administering it? I mean, that would really be a turf issue, which, of course, then will have to be dealt with the highest level of the policymakers in order to see how this can be done. Because in my view, it doesn't really make any sense to bring in a separate bill. And when that bill was brought in 2016, and some of the people like me who deposed as experts before the parliamentary committee did make this point very clearly, that we believe that this should really come under the fold of Insolvency and Bankruptcy Code itself. The second choice that will have to be made is that, like in the FRDI bill, it was proposed that there should be a resolution corporation. Right now, well, I do understand that IBC was very new at that point in time. IBPI as a regulator was very new at that point in time, just about a year old. But now Insolvency and Bankruptcy Board has, and I'm just going to wrap up in 3 minutes. Now, the Insolvency and Bankruptcy Board of India has more than 7 years of experience, has built formidable institutions, and we should actually be making best use of those institutions to be able to sort of provide support to the new framework that will have to be built under the bank and financial institution insolvency. And the third point, of course, also will have to be considered, and that's a point that Maiti also made, is that whether you really want court involvement, and if yes, to what extent. That also we will have to then decide whether that's the jurisdiction that needs to sit with the national company law tribunals, or do you need to have special benches for that, or do you want a different kind of members sitting on those special benches other than the technical and judicial as provided at the moment, or should there be technical with special expertise? Now, these are the 3 or 4 policy choices that will have to be made. And the fourth one also, which of course, in my view, is although a very critical issue practically, but legally, one cannot make a distinction between a public and private sector bank when it comes to providing a framework. The legislative framework will have to apply absolutely alike to the public sector and the private sector banks. Even though lopsidedly, the banking sector is today in the public sector bank's favor, but when it comes to the law, you can't make a distinction. But yes, in terms of the treatment, when you actually provide a resolution to a particular institution, whether it is a public or private sector, the dynamics will decide what kind of treatment is provided. But a broad legal framework, regulatory framework, approaches, jurisprudence, the principles have to be the same for both. And that is not just an issue with regard to the public trust versus, what other issue. It is in fact because you are creating a free market economy. Right? When you're creating a free market economy and you want investors to come and invest in the banks and other institutions, then you can't really be creating an unlevel playing field. Either the field has to be absolutely level playing, and therefore to that extent, even the insolvency law, to the extent that it applies to corporate entities, it doesn't make any distinction between state-owned enterprises and the private enterprises. The same treatments are provided, and we have had in India almost a dozen of state-owned enterprises having faced insolvency. Some of them actually having gone into liquidation. So, in my view, I think these are some of the critical issues that will have to be dealt with at a larger macro level. And of course, micro level, we'll get guidance from the InvIT documents and other documents, and of course, our own experience of running banking sector for centuries, for that matter. So Professor Shana, I'll stop here, and these are my general comments, and of course, we'll be happy to share my comments with Professor Muni on the side to help him in any manner, in the development of the paper. Thank you.
Thank you so much, Sumant. Of course, this is a very unique also area, because we're looking at banks and financial institutions separately in India. So I just want to allow Professor Uni for a minute, if you could very briefly respond to each of the responders, perhaps 30 seconds each, and then we can have one broad sort of question for the entire panel and one audience question, if that's all right.
So can I speak, Ishana, now?
Yes, sir. Please go ahead.
Yeah. Okay. Thank you so much. I learned a lot after listening to all the panelists. It's brought in very interesting insights to the entire paper. As I told you, this is a process of learning. That's why it's called a working paper. And I benefited immensely from Mr. Gupta, Professor Mirite, and Mr. Sumant Batra also. And of course, there are certain areas where we need to have multiple rounds of discussions, whether we should have the same kind of treatment for public sector and private sector banks. For example, if you see the merger landscape and all, RBI differentiates between these two sectors. So we have to see whether they can have the same kind of formats for all those. But anyway, it's a very interesting process, insights which you have brought in, especially from the perspective of international framework. So the concepts leading to transfer of deposits and all, some of them we can even try it here. But the major stumbling block with respect to 2017 law was the clauses dealing with bail-in. And that in a way killed the legislation, because government initially wanted to move forward on that. Then this became a big issue. And it's at that time also 2019 elections were happening. So they also thought that, if you are going to bring this bail-in clause, and this will have serious implications when it comes to winning elections also. And opposition parties somehow were able to communicate or convey to the public that all your deposits will be taken and converted to bonds or other securities in case of if any bank experiences. Though there were a lot of conditions for that, but the moment you hear these kinds of things, people always get scared. And the fact that the deposit insurance has been hiked from 1 lakh to 5 lakh, I think it should be more. That may offer a kind of a via media solution, because that to a great extent covers most of the small deposit holders and the people who are really concerned about losing their money through these kinds of processes. But definitely it's a starting point, and I'm sure this will, the insights from all of you would help me to really streamline my paper and have, and this paper, when it was written last year, we couldn't include some of those cases. Again, we have more cases coming up. So that also will be added to make it much more robust. But thank you so much for all of your valuable time and insights. I have learned a lot from this. Thank you so much. And thanks a lot, Ishana, and all the organizers here.
Thanks so much, Professor Uni. So I just wanted to open I think this is a broad question, and go around the table to understand this question. There's often a confusion between treatment of public funds, which is effectively from government securities, and public deposits. So we have obviously focused on the issue of deposit insurance, depositor protection. But there is a split that is to be addressed when it comes to public funds and public money. And this was a very interesting conversation from yesterday's, a Sunday's panel, which was split into two parts. From Sunday's panel, which effectively spoke about the manner in which public sector banks in India or public financial institutions in India, one must remember that they are ultimately government. So when you're looking at a government sort of priority of payment, which is below, and when you're trying to reassess the model in which you will be doing a reorganization because you want to balance out perhaps public funds and public deposit holder money, I'm just curious to go around the table. Perhaps we could start with Satish, then Mehte, and Sumant to sort of understand how this particular division should work if you're trying to design a comprehensive bank insolvency regime versus a financial institution, which is essentially a company in the lending business, which is not necessarily deposit holder or taker in nature. Satish, first to you.
So first of all, I agree with the Suman that there has to be a comprehensive framework. Given the we are now in a much more volatile and interconnected global. And now, not only that, now we see the convergence of various businesses, whether it's in insurance or general insurance, life insurance, asset management, or fintech. We are having many more aspects to deal with that. And every time we cannot have the central bank dealing with it, there has to be a transparent framework, accordingly, which will that particular entity will be dealt with. So that is first. Secondly, over a period of time, from the certain resolutions from or the major reorganizations which have been taken, I think there are certain well-established principles and which have been tested also. So as we know, equity of AT1 bonds, being written off, or in PNC Bank, deposit to the extent of what is the insurance given by a deposit insurance credit in guarantee scheme, and the balance amount of the depositor being paid from the recovery of the loans or the assets which that particular filing bank had. So we already have certain principles established, and Reliance Capital was another example where different kind of the assets were involved and how these were resolved. We also have seen earlier NHB, National Housing Bank, they used to be a regulator for housing finance company, and when DHFL, that is the housing finance company, went into crisis, how the RBI had taken the particular regulator's role into themselves. So these are all we have seen knee-jerk reactions, which happen. However, based on the whatever few cases which have been dealt with, and the learnings and the principles which have been tested, as Sumant mentioned, it will be good to have a framework to deal with that, from those experiences.
Mehte, your thoughts?
Yes, thank you very much. Well, on the topic of public funding, I think first of all, so the key attributes and we as well advocate that the use of public funding should be minimized in case you deal with bank failures, and even I mean, it's less justified even if the bank is non-systemic. So even for our legislative guides. And you were talking about the deposit insurance scheme, but at least for our purposes, the use of funding from the deposit insurance scheme, if this is done in accordance with the mandate of the deposit insurer, that's not considered public funding because the banks, they pay into the deposit insurance scheme. So it would not be considered public funding. For the issue of public funding and state-owned banks, well, that is not something that we specifically cover or discuss in the working group. But I would think personally that probably a resolution action would be avoided by a recapitalization by the shareholder, which would be the state to the extent possible. And I think probably the biggest challenge in the resolution would be applying bail-in, if this would be an open bank bail-in, where actually then the creditors would become the shareholders of the bank and therefore effectively privatizing the bank, making it a private bank instead of a public bank. But that is not something that we deal with specifically in our legislative guides. But I find it very interesting to hear that India has such a big public bank sector. So this is something that I will definitely take back also to the working group. Thank you.
Thanks so much for those thoughts, Merte. I am also mindful of time, so I'm going to invite Sumant to also provide some closing remarks on this particular topic and the event, and then close out. I think our live stream has a lot of comments for this particular panel, and sifting through them, I'll probably consolidate them and send it across for discussion, a lot of conversation around public funds and public deposits. So I'm going to now invite Sumant to sort of give final remarks and his closing thoughts on this particular panel.
Thank you so much, Professor Tripathi, once again to give me that opportunity. Well, I think, Professor Tripathi, what you've really done so well is to be able to sort of bring this issue again on the front burner. And this discussion, this deliberation is really going to be very, very important in terms of creating an impetus that we've been really wanting to do for some more time now, because after the bill was withdrawn, the discussion just went on the back burner. And you're aware, and in fact, most of you on the panel here would be aware that we have recently, as ILS, signed an MOU with Unitroid to work together on a number of areas, including the bank insolvency. And we're hoping that together we will be able to sort of help the policymakers here in the region, not just in India, help in framing of the policy and capacity building and all the other efforts that would be required. And through this platform, Professor Tripathi, if I may inform that today is in fact also special in the way that we are today announcing our bank insolvency thought leadership projects, which include three things. One, we are setting up a thought committee headed by Dr. T.K. Vishwanathan. And we have the former Deputy Governor of the Reserve Bank of India, Reserve Bank of India's Research Center representative, and some of the leaders from the country on that committee. And we hope to start. The second very interesting step that we have taken is that for the next ILA conference in February, we have put bank insolvency as one of the core areas, and there are 5 papers that have been invited from all around the world, from leading experts. That is all with the objective of sort of, creating an impetus, creating a focus on the topic of bank insolvency and help the policymakers create, help in the preparation of the foreground for the policymakers to be able to do that. And the third thing which we are going to do also, and of course we'll talk about that Professor separately also, is that we are setting up a chair on bank insolvency. The seat of that would be in all likelihood in Bombay, but this would be a collaboration between one of the universities in down south and in ILA. And again, the whole idea is that we are able to bring in all the research under that chair. So why I wanted to mention this was that clearly we recognize that in a very short period of time from now, this topic would require utmost policy interventions and attention, and as market players, as researchers, as those who have experiences behind us, we should really be doing our bit in terms of helping the government prepare, the central bank prepare the policy and the regulatory framework on this, and assist in whatever possible we can. And we will engage with the market, we'll engage with the stakeholders. We will continue to do more papers, more research, and I'm sure Professor Oni's paper also will become very, very useful. So, hats off once again, Professor Pati, for including this topic and just bringing the right kind of people, including.
Thanks so much for those kind words. So much.
Thanks a lot. Thanks a lot. I have been the biggest beneficiary from all these insights all over the world. So thank you so much, Ishana, for coordinating all this. And thanks a lot, Sumant, Satish, Mirte, and all for your excellent insights, which I'm sure will help me a long way in refining this paper. Thank you so much.
Thank you, everyone. Thank you, everyone who's tuned in. I'm sure there is a lot of debate that is going to be upcoming when it comes to bank insolvency in specific. Thank you for those who've attended all the 4 sessions for this working paper series. And we will be publishing these papers on our SSRN platform soon. So stay tuned, and thank you, everybody. Have a good Tuesday.
Thank you, everyone.
Thank you. Thank you so much.
Thank you very much.
Thank you.